Welcome, friends, to Alpha Beta Soup. I'm TXMC. Today will be part 3 of a multi-part series looking at economic downturns. We've explored what the NBER finds important for dating official U.S. recessions in part 1. In part 2, we expanded our study to include many other facets of the economy, and we modeled a skeleton key framework, kind of an average sequence of events that these downturns, these sagas, normally play out in. What we need to do today is talk a little bit about how the Fed plays into this, some of their expectations for unemployment, what that means for the recession. And then we need to talk about what the market does in recessions, how it makes new lows, how far in the past it goes to take out old levels. We'll talk about those things in today's video. This may not be the last video of this series. We may do one more after this to talk about a few aspects related to Bitcoin. But before we get started, a couple of housekeeping items. If you enjoy this content, please give this video a thumbs up and subscribe to my channel. I am a one-man operation and I appreciate your engagement. I'd really like to get this series in front of more eyeballs because I think it's good work, so I'd really like your help in sharing this with people you know. And always a disclaimer, please do not make investment decisions based on what I talk about in my videos. I'm just a guy on the internet doing personal research. You need to do your own research before putting any of your money into the markets. And lastly, I will be traveling for a few days this week, so today's video will be the last one until either Sunday or early next week. Now with all that out of the way, let's get started. Today was an FOMC meeting. The Fed decided not to raise interest rates, to hold them at the 5% to 5.25% range that they've been at since May. In addition to the policy meeting, every quarter we get another one of these sheets here, which is their summary of economic projections. They survey everyone on the board and ask them where they think these various metrics will be over the next 2 to 3 years if their policy plays out according to plan, if they're able to do everything that they expect they want to do. Now, this number is not something that they get into a room and decide upon. It's the median outcome of the entire group being surveyed individually. So it's kind of an interesting number. It's not so much a forecast, but it can be thought of in a sense as what they're mentally prepared to see if their policies are played out. And the thing that I think we'll really want to focus on today is right here. It's the unemployment rate. So their projections have been a little alarming in what they've shown with the unemployment rate. If you've been following this channel since last year, we've been exploring the focus Jerome Powell has placed on the labor market. He places a lot of emphasis on the tightness of labor demand, how it far outstrips the amount of willing and available workers in the economy today, and he has talked about expecting to see labor softness for over a year now. There's a lot of things we could say about what labor softness might look like, but today I want to focus on the delta that they are expecting based on these projections from where unemployment is today and how that fits into what normally happens historically. We'll just keep it kind of simple here. And what you're seeing on the screen is for this year, for 2024 and for 2025, the group, the FOMC board, they expect unemployment to be 4.1% and 4.5% over the next 2 years. Down slightly from 3 months ago when the whole group expected at least 4.5% unemployment this year and then 4.6% for the next 2 years. So we can see their projection for this year came down 0.4% and the next 2 years down by 0.1%, but still remains high. Today's unemployment rate is 3.7%. It just recently ticked up from where it's hung around 3.4 or 3.5. 3.4% is the cycle low. Now, why does this matter? Well, there's a couple of dynamics about unemployment that it's important to point out. So unemployment is one of those kinds of metrics that goes down really slowly over long periods of time and then quickly rises, and then goes down really slowly over long periods of time and then quickly rises. This is the dynamic. Unemployment does not do this, where it rises and then falls, and then rises slowly and then falls, the way you might expect a price chart to do. It's quite the opposite. This is what unemployment looks like. And you can see we have these long periods of expansion. These are people being hired more more than they are losing their jobs on a national level. But we go through these periods where unemployment suddenly leaps higher, and those periods tend to align with recessions, which are these gray bars you see on my chart. Now let's focus on this number here. The Fed, like we said, they're showing unemployment rising to maybe 4.1% this year. That's what they're comfortable with seeing. They actually thought as recently as 3 months ago that it could go up to 4.5% from, again, where it began at 3.4%. So they're expecting that unemployment could rise 0.5% to 1% over the next year, before the end of this year even. Well, that is problematic. The problem with that projection is that unemployment doesn't have a good history with rising just 0.5% and that being okay. So if we go back in history and we look all the way back to the beginning of the unemployment series, which started in 1948, and we chart every time that unemployment rose 0.5% in either a 12-month or even a 6-month span, we can see those charted down here at the bottom. Red shows unemployment that has gone up from its lows by 0.5% in a 6-month time frame or a 12-month time frame in blue. And what you'll notice is that these colors, these prints of these two values here, they only appear next to these recessionary bars. There's a single dot right here. There is a single dot right here, a couple of dots. But 99.9% of the occurrences of unemployment rising 0.5% in a year, or even taking an entire year to do so and doing it much more slowly, all of those instances were recessions. There are no periods where that was not the case. So when you see a Fed that is calling unemployment at 4.1% right here for this year, and it is currently up 0.3% off of the lows from 3.4 to 3.7, which you can see here from 3.4 to 3.7. So it's already up 0.3%. And when we look back through history, when it gets to 0.5%, and it does so within a year of starting to rise, that has meant we've had a recession. But there's another detail of this. So the Fed shows unemployment in their projections rising 0.5 to 0.8%, somewhere in there, and just hanging out for the next couple of years and not getting any worse, not getting any better, just staying up 1% from where it began. Well, unfortunately, we have 0 instances of that ever happening in recorded history. So the Fed is projecting a fantasy to you. They don't have any historical context for this happening, and this is an organization that employs hundreds of PhDs, people that went to Ivy League colleges that paid a lot more for their education than your boy TXMC did learning for free on the internet. It only takes a little bit of time and the willingness to chart this to see just how much bullshit is being peddled to you in these economic projections. Because again, unemployment went from 3.4 to 3.7. It's up 0.3%. They say it's going to rise another 0.4%. Or at the very least, maybe they don't expect it to rise, but they are willing to see that. They are willing to see unemployment lift up off of its lows by at least 0.5 percentage point. But the problem is that every time it does that, it means a recession. And every time it does that, it goes much more than 0.5%. This is the axis representing how many percentage points it normally travels. Most of these lines hop above the 2 on the left axis, which means rising 4 times higher from 0.5% to 2%, 4 times higher than the threshold needed to appear on this chart down here. Only rising 1% would be halfway from this 0 to this 2. And if you look across, there's almost no instances of it only rising 1%. In most of these cases, it rises 1.5% to 2% or considerably more. So if we're going to have unemployment rise potentially 1.5%, and we've got a labor force of 167 million people, you're talking about maybe 2 to 2.5 million people out of work. And that's something the Fed's comfortable with. It fits into their projections. And it's possible that they could see this kind of an outcome and not feel compelled to lower interest rates, which is not what I think the market is planned for. If you look at Fed fund rate futures, which we're not going to model in this video today, but maybe we'll talk about in the future here, they're already pricing in cuts at the end of this year. They're expecting the Fed to see something that causes them to lower interest rates. And if unemployment starts ticking up a little bit higher from 3.7, gets up to 4%, 4.1, and we're right in the wheelhouse of what the Fed thought, are they going to feel compelled to lower interest rates? Will they feel compelled to keep them there? And if they do, how much higher will unemployment go? Will they be able to engineer an unemployment rate that simply rises 0.5% and then just goes sideways, which is unlike every other time in recorded history when unemployment goes down very slowly for very long periods of time, and when it rises, it does so quickly and in an uncontrollable way. So when I look at the Fed's unemployment rate projections here, I don't necessarily think of it as a forecast. I don't think necessarily that they are targeting 4.5% unemployment, but I do think it represents a comfort level with the board, because if you recall, this is the outcome of a survey of the group. So all of them together are showing you that they are mentally prepared to see higher unemployment. However, when we get higher unemployment, it's usually much higher than what they are projecting their ability to control. And all of this matters because unemployment is the recession. It is people losing their jobs. It matters for GDP because we are a nation of people spending money. That is what is our economic growth by and large. This is a chart representing consumption as a percentage of GDP. Remember that consumption is people spending money. GDP is the nation's income. So beginning in 1965-66, this number began to climb, and it has climbed from the high 50s up to 68.3%. So over 2/3 of the economy is people spending money, and they can't spend money without incomes. This is what is helping to fuel inflation in a lot of ways. If you look at the rate of change of wages here on a 12-month, 6-month, 3-month, or 1-month annualized basis, wages are still growing at 4.5%, 5%. That's helping to fuel inflation. That's part of the outcome of the tightness in labor, of the fact that there are more demand for jobs than there are people willing to take them. So when I see the Fed projecting unemployment in the way that they have, and it doesn't align with outcomes that we can find historical context for, it makes me concerned that we are headed towards an outcome that will not look the way that they think it does. It will affect their reaction function, but I also think that the market has not sufficiently anticipated how exactly this could play out. They still think that we're going to maybe have some weak little dip, that the Fed's going to get cold feet and they're going to pull back and start cutting rates. But when you look at their own projections, they're willing to stomach a little bit more unemployment. This is another couple million people losing their jobs. So that is something to be concerned about. And if this comes to pass, if they get this unemployment rate, unless this time is different, which as we discussed in the prior video, it's difficult to make that bet. Unless this time is different, we should expect a recession. Now, something else that I've been looking at is CPI related to recessions. And this is yet another feather in the cap of high odds for a recession in this cycle, as it being the main outcome. It's based on something that I heard Stanley Druckenmiller say in an interview over a year ago. He said every time we have had CPI over 5% in the United States, the Fed had to raise federal funds over CPI, and that we didn't get out of it without a recession. Now, I found that kind of interesting. Whenever I hear people say rules like that, I always like to go look them up myself and chart them. It helps me to understand how things work a little better. So I decided to do that. Up here at the top, we have CPI. This little dotted line is 5%, just as kind of like a visual representation. And we've got a couple of sets of boxes down here. These blue boxes in the middle are only printing blue when CPI is above 5%. 5% or more on a year-over-year basis. That's how we normally measure it. Down here at the bottom, this prints when CPI is over 5% and there is a recession 1 year ahead or sooner. Now, what I've noticed, first of all, we have a lot of periods of time where CPI has been over 5%. Going back to the 20s, this is the after World War I here. We've got high inflation in the early 20s. We had some in the 30s, in the 40s, and then obviously in the 60s and 70s, which everyone's familiar with. I also find it pretty remarkable that virtually all of these these cases had a recession right after them. Some of them are high inflation into a recession. We had that a few times in the 70s. There are a couple of anomalies. So right here, we had CPI over 5% in 1934. But what you'll notice is that just before that, we had straight up deflation of 10% annualized on an ongoing persistent basis for about a 2-year period. We had massive deflation in the Great Depression. So bouncing out of that to 5% CPI, I don't really want to consider this in our study here. The next one that really stands out is right here. This is during World War II. We had massive inflation during World War II. There was a lot of economic distortion. We had price controls. We had commandeering of the manufacturing industry in order to promote war defense, to help build for the war machine. So this is a period right here where we had very high inflation and we didn't have a recession for a couple more years. This is one of the rare instances, but we were in the middle of a world war. We had just joined World War II. This point right here, this is Pearl Harbor, December 1941. These other instances were periods of high inflation and then there were recessions soon after. This one doesn't quite meet the threshold. It's just barely after my cutoff rather than a year. It's about 18 months later. All of these other instances have seen recessions, corroborated by these red bars joining the green ones above down here. And then you look over where we are today, and we've had this prolonged stretch since August of 2021 until just a couple of months ago, when year over year CPI was over 5% persistently, but we haven't yet experienced our own recession. Will we? Well, the odds are stacked in favor of it, as we've talked about. The yield curve says we will. Manufacturing PMIs strongly suggest that we will. The Fed's projections for what they think unemployment is going to do strongly suggest that we will. Many of the metrics that normally turn down in recessions have begun to do so. We noted that in the prior video. And then we have this high inflation problem, which does appear to be resolving itself. But does that mean we're going to avoid the same outcome that we've experienced over and over again for a century? If we do, we can say with confidence that this time is different. But as we talked about in the previous video, I can't really make a risk-adjusted bet that this time is different. If we move forward with the expectation that a recession is not just possible, but in fact is likely, and it would be anomalous for us to avoid one, well, then we can start to think, okay, if we don't get one, then that's great, right? I've got a 401k, I have a retirement account, I've got some Bitcoin, I'm long risk. I'd love for prices to go up, but there's a high chance that they may come back down, no matter what happens between now and when the recession starts. Does that mean that we'll get new lows if we do have a recession? Is that insured? Here is a look at a bunch of different eras. Let me trim down my chart a little bit. These are a bunch of our recessions here that we've been using in our study going back to the Great Depression. These black triangles represent the low of the market for each given era. The line here in the center, this dotted vertical line, this represents the start of the recession. That's the event we're currently anchoring these fractals to. The takeaway from this is that the beginning of all the recessions that we have data for came before the low of the market for that period. Every time we have had a recession, the low of the market came afterward. It came later. In some cases, it was 90 days later. In some cases, it was half a year or longer. 2 or 3 instances were over a year later. But it is the case in 100% of these instances that the low of the market was into the recession. It was not beforehand. We did not price in the recession before it happens. I see this talked about a lot on Twitter. I see people say things like, well, everyone knows the recession is coming, so it's all priced in. Information travels so quickly today. The market already anticipated these things. It's baked into the price. Well, if that's your thesis, you're certainly entitled to it, but I don't find much data to support that perspective. I find overwhelming data to suggest to me that if we are going to have a recession, which we have been studying the appearance of, we've been studying the various metrics that turn down in a recession, what they look like and the order they happen in. And another thing we can add to that list is that the bottom of the market is always after the recession begins, with 100% occurrence so far in history, and this is going back 100 years. And then you say, okay, all right, TX, fine. Maybe we're going to have a recession. Maybe the market's going to fall. But you know what? If the stock market goes high enough between now and when that happens, then we won't have to worry about it. The lows from October will be defended and we don't have to revisit them. We'll just set a new higher low and everything will be fine. Well, I'd like to believe that, but I've got some more data. You guys know I love to make me some charts to disprove a common theory. Here is a look at every recession dated from the oldest low that was violated by the downturn. So all of these are fractals of various recessions. This is 2007 to 2009. Now in the fall in 2009, at the bottom down here, which was March of 2009, it violated lows going back many years. You can see virtually the entirety of the tech bubble existed in the fractal that was violated by the lows from the Great Financial Crisis. It took them all out, and it fell down to a place that took out a low from 12 and a half years in the past. Here is what that looked like. Here's the S&P right here on a 3-day chart. Here's that low right here. If you go all the way back in the past, look at that. 4,500 some days of lows that it took out, including the entirety of the tech bubble. That's the fractal you're looking at here, right? You're starting to understand how this chart works. So all of these numbers down here, all these fractals, show you how many years of price action were erased by the fall in a given recession. What you'll notice is the vast majority of these numbers are at least 2 or higher. Most of them. There are 3 instances among all of these instances where a low was violated from just a year and a half in the past. But most of them, including this one if you count it, which is 1.9. All of these other ones, with the exception of 2, 1980 and 1991, all the others took out lows that were at least 2 years old. Now, I think that this average is being dragged up by a couple of these worst defenders here. Now, keep in mind, we're not including the Great Depression in this list because if I do, it'll blow the water out of everything. It was 24 years worth of lows that it erased in the fall. But we've got this group here, so let's get rid of the worst 2 offenders. The average changes to 2, 1.9, let's call it 2. In every recession, on average, we take out lows from at least 2 years ago, sometimes much older than that. But on average, it's about 2 years. So, okay, carry this exercise forward, right? Let's get our little date tool. Where does that put us? It puts us in October of 2024 here. This is where we need to get to. If we're going to bypass the average amount of time that a recession wipes out old lows. Now, we know, we just looked, it's not foolproof. And in fact, there are many instances of recessions taking out lows from 3, 3.5, 5 years or longer ago in the past. But if we want to get past the chunk of this group, then we'll call it 2, maybe 2.5 years, maybe another half a year from this point right here, which would take us out into April of 2025. In an ideal world, we would see the market continue to climb higher up to at least this point here before we had a recession. And then it could still come all the way back down and take out these lows. And it would not be a ridiculous thing compared to history. It would not be something unprecedented. Now, people maybe find that hard to believe. How could the market just erase all of this? How could we have this massive AI bubble, which is clearly going to change the world? Nothing's ever going to be the same again. We're never going to work again. It's going to quintuple productivity on a monthly basis, and we're going to just live in a utopia. There's various versions of this theory being bandied about right now by the bulls. But we've seen, and we're seeing here on this chart here, we could take out lows from quite a long time ago in a recession. And in every recession, the low is after it begins, not beforehand. And if we think a recession is likely, this kind of exercise may prove quite useful. So if I'm a bull and I'm watching this presentation, I should seriously hope that we do not experience a recession until we at least get to this window of time right here, October 2024 to April 2025, preferably past this point, preferably out into here before we experience experience a recession. If not, it's a near lock in terms of likelihood that these lows right here are not well defended. And you may be saying to yourself, this time is different, TX. This is the most telegraphed recession in history. Information travels faster than it ever has before. Whatever your thesis is, if you want to believe this time is different, that's totally okay. But I think it's worth pointing out that someone always thinks that this time is different. National Bank of Belgium. This is from a research paper from 2019. Experience shows that commentators tend to downplay the signals given by the yield curve. Here they studied the efficacy of the yield curve. In fact, when asked in 2007, 2000, 1990, and on earlier occasions, most economists indicated that this time is different, meaning that this time the yield curve inversion will not be followed by a recession, yet a recession occurred every time. In addition, the person who helped to discover the yield curve and to recognize it as a recession harbinger, they even came out here in February and said, this isn't going to work this time. My yield curve indicator has gone code red. It's 8 for 8, but I have reason to believe that it's flashing a false signal. Additionally, Goldman Sachs, who are a little bit of a joke, and yeah, they get things wrong a lot, but people pay attention to what they say. Investors appear to be wedded to the secular stagnation, low R star, that's a natural rate of growth, view of the world from the last cycle. We believe this cycle is different. The yield curve, this time it is different. Maybe these people will end up being right. We find that again and again, people make the argument that this time is different, and without fail, every time they are proven wrong. So I stand by my thesis. I have not wavered at all. You have people out here flip-flopping every couple of months, and that's fine. If I'm going to be the guy who sounds a little bearish while everyone's losing their mind into the retrace levels, we've got an S&P that just hit the 702 retrace, climbing up to it right here. It hit it on ES. Look at that. Totally at the retraces. So if everyone's going to be bullish here, that's fine. Maybe the market keeps climbing. Maybe I'm dead wrong. Maybe we just keep making higher highs and just keep inching higher and higher. That's totally fine. I'm okay with that. I've presented a very convincing case to you over the course of the last 3 videos that not only is a recession possible, but it should probably be the base case of everyone in the market. Now, it's hard for a watched pot to boil. If everyone is watching for it and positioned for it, then it's going to be difficult for it to come. So I know that we've talked about a lot of information here today. We looked at the unemployment rate and how when it rises at least 0.5% in a 6-month or 12-month period, that's happened in a recession every time. We've also pointed out that it doesn't just rise 0.5%. It normally rises much more than that, which brings into serious question the Fed's own projections about what they think can happen. It also should bring us a little bit of ponderance, a little bit of concern that the Fed seems comfortable with the idea of higher unemployment when we have explored that it's very unlikely for unemployment to rise in such a controllable way. Chances are, if it gets away from them, it's going to rise much more and put a couple million people out of work potentially. We also explored that the market makes new lows in recession with 100% accuracy. There hasn't been a recession in our model here for which that wasn't the case. And additionally, we also explored that in a recession, lows from 2 or 3 years or more ago in the past are frequently violated without trouble. And when you look where we are today, this is where we are since our October lows. Our fractal looks pretty puny compared to many of these others here. So I think that there is ample evidence to not only think a recession is possible, but to have it as your base case probability. We've explored multiple signals that are aligning to suggest that outcome is extremely probable, and we know that price is not safe in a recession. What happened in October will probably be revisited again unless this downturn is pushed at least 2 or 2.5 years out into the future before we can really start to feel comfortable just based on historical context. If you have any feedback for me, make sure to leave it in the comments down below. I will review them. I hope that this video made sense. As I was talking about it, my mind was kind of jumping around at different points. So I hope that it comes through in a cogent way and that it fits with the previous 2 videos. These are the outcome of many months of work and study, and it's been a treat and a challenge for me to figure out how to present them to you in a way that makes sense. You've been giving me great feedback so far. I hope that this one meets your expectations expectations, and we may have a few more points to discuss in the next video, particularly as economic downturns relate to Bitcoin. I've got a couple of ideas about what I think is happening between the economy and Bitcoin. Some of those ideas might be familiar to folks who've been watching me for a long time, but it's important for us to bring some of those concepts back today as we're doing so much recession talk. Make sure you follow me right here on Twitter at TXMC Trades. This is where I post all of my analysis. I'm very active here and my DMs are open. And that's where we will leave it, friends. I need to travel for a couple of days, so I won't make another video until either Sunday or early next week. Once we complete this recession series, we'll get back to more timely market observations and analysis and just kind of going off the cuff. But I really wanted to get this out there first because it's what I've been working on during my off time. And that's where we will leave it today. Until we chat next time, take care of yourselves, take care of your families, and we will meet again in just a few days' time. With all that said, I bid you adieu. Cheers, friends.